Hello and welcome everyone to our podcast series Money Matters on money, banking and central banking by the Institute of International Monetary Research. The purpose of the Institute is to demonstrate and bring to public attention the strong relationship between the quantity of money on the one hand and the levels of national income and inflation on the other. I am Damian Pudner, Director of the Institute, and today my guest is renowned economist, author and blogger on banking and the financial system, Francis Coppola. Francis, welcome. It's a real pleasure to have you with us today. Talking about bank reserves, I mean, there have been a number of suggestions that the Bank of England and other central banks should stop paying interest on bank reserves, or at least reduce the level at which interest is paid on reserves. I mean, what's your view on this, and do we risk this issue of fiscal dominance then?
Well, stopping paying interest on reserves is when you've still got large amounts of excess reserves in the system is a tax on banks.
Mm-hmm.
And ultimately, that will flow through into lower interest rates on deposits, or shall we say, banks not raising interest rates on deposits.
Mm-hmm.
If I explain why this matters, okay, reserves for a bank are part of their funding. So they use reserves to settle payments, and those payments could be loan drawdowns, or they could be securities purchases, or it could simply be intermediating deposit withdrawals and payments on behalf of customers. They use reserves for all those things. What they don't do is lend them out.
Exactly. It stays within the financial system.
Absolutely. All the reserves that the Bank of England created in well over a decade of QE, and particularly obviously during COVID when it went up vastly, have stayed within the banking system. They cannot leave it. So collectively, all the banks have got to hold those reserves, right? So if the Bank of England stops paying interest on those reserves, then the cost of funding for the banks will be then in effect the cost of funding for the banks will be zero. If I explain how that works, so if you've got if you're holding assets, which is what reserves are, on which you are earning nothing, and collectively you can't get rid of them, then the cost of dumping those assets on somebody else is going to be negative, right? So, and that will mean that other forms of funding, such as deposits, will also be negative. You will be looking at negative interest rates on deposits if you stop paying interest on reserves. That completely. What people have been discussing though is not stopping paying interest on all reserves, but doing a little bit like we had with the funding for lending scheme. I don't know if you remember that.
Well, that's right. They're talking about this kind of tiering
Tiered
system.
reserves, whereby you basically say to a bank, if you do this kind of lending, then we will cut your funding costs on that type of lending.
Right.
So if you are doing lending to first-time buyers, if you're doing productive lending to small businesses, then we will cut then because this is on excess reserves, then we will essentially pay you for reserve in positive interest on reserves for anything, so for an amount equivalent to the amount of productive lending you're doing, if you see what I mean.
Yes.
And any other reserves you hold, you get nothing.
Right.
Okay, so obviously then there's an incentive for a bank to do more productive lending in order to be able to earn some interest on the reserves they're obliged to hold. That's how it works.
Do you think the Bank of England will eventually have to end their current QT program? Do you think we could even envisage a return to QE if things get as bad as maybe some of us think they will do in 6, 9, 12 months' time?
Yes, absolutely. I mean, QE now has been normalized as part of the central bank toolkit. So if we had another recession, I have no doubt that the central bank would end QT and possibly restart QE. I don't think that we have fully understood yet so we say the externalities, the consequences of deploying QE so continually as a normal part of the monetary toolkit. But that is where we are now. When they talk about QE, they talk about it as normal policy, and they're still talking about helicopter money as something very strange and odd, and we're not at all sure we ought to be doing that. And I find this bizarre because the distinction is not that great, really. It's not a matter of distribution.
No, exactly. And of course, when the Bank of England introduced QE in 2009, it was always envisaged as it was going to be kind of a temporary thing. It was
Absolutely.
never intended to be this decade-long, go-to tool. It's not an unconventional monetary policy tool anymore.
No, it's very much a conventional policy tool. It's, oh, if we've got another recession, right, we'll just turn on the QE taps again. We cut interest rates along with zero interest rates, of course, which we should
Hmm.
remember were very far from normal policy.
Correct.
But
Yes.
we have, after over a best part of a decade of interest rates being close to zero or even actually zero, now
Hmm.
it's become kind of normalized, and we're talking about 5% as somehow abnormal. You go back to the early 2000s, and 5% interest rates were normal, and nobody had ever heard of zero interest rates.
Exactly. I mean, this is the problem that the argument, as an institute we've put forward for many years is that, you know, emergency interest rates are just that. They're for an emergency period of time. A decade long plus, near zero interest rate policy is the problem for the Bank of England. They should have raised interest rates like other central banks a lot sooner.
Well, perhaps, but they were in a way being held to ransom by a government that was intent on pursuing fiscal austerity
Hmm.
in a very weak economy, and requiring the Bank of England to cover for them. It was actually explicitly laid out by George Osborne to the incoming Bank of England Governor Mark Carney in the Mansion House speech in 2013. There
Hmm.
wasn't really anything else the Bank of England could do, because one of the problems, and it is in a way a form of fiscal dominance that's been bothering me for years. But fiscal dominance classically is the situation where you've got a profligate government that is going ahead with massive spending plans, irrespective of its means, and then the central bank has to come along afterwards and try and mop up all the money that it's spending, and therefore is unable to control inflation. That's classic fiscal dominance,
Hmm.
right? Where yeah, but there's also another form of fiscal dominance, which in a way is not as acutely obviously problematic as that form, but it's damaging in its own way. And that is where you've got the opposite. You've got a government that is hell bent on fiscal austerity that particularly hurts the poor, actually.
Yes.
The coalition and then the Tory parties and the Tory government's policies were specifically aimed at the lower, at the poor, really, and they were coupled with actually quite profligate spending plans at higher income levels. For example, there was a lot of help for richer people in the housing market. There were tax cuts for corporations, those kind of things. So overall, we have seen overall, therefore, when you start giving money to rich people and taking it away from poor people, overall, that's a drag on your economy. It's a drag on demand.
Yes.
Yeah. So
Hmm.
your central bank is going to have to keep policy loose in order to accommodate that.
Right.
That, to my mind, is a form of fiscal dominance. In other words, the government is going ahead with its tax and spending plans, which widen income inequality as well as wealth inequality, and suck demand out of the economy. And the central bank is then obliged, because of its inflation target, to try and
Hmm.
support demand to stop the economy falling into a slump and inflation falling below target. And that can go on literally for years,
Yes.
with the central bank struggling to get inflation up to target, with a long running slump. You may not actually have a recession as such, may just
Hmm.
be a long running slump because demand is so weak, and a tight a fiscal stance that is may not be tight in the sense of actual sort of front-loaded deficit cutting or something like that. In practice, it was meant to be, but in practice, it didn't quite work out like that. But where the spending plans are, shall we say, aimed at the wrong people.
Exactly. I mean, I guess the argument is that, certainly looking just at 2020, to bring it up to date, I mean, the bank and the government were just doing what they had to do to deal with this unprecedented external shock. But I mean,
Sure. And actually, a lot of what the government did in the early parts of the pandemic, I have to say this: there's been a lot of criticism of things like the furlough scheme now, and for sure it was in some respects poorly targeted. It was open to abuse, but if we hadn't had that, we would have been in a much worse shape than we are. So in a way, I am inclined, and it was unquestioned in an emergency situation. It was unprecedented. We'd never done anything like that before. Nobody really had any idea how to handle it. So it's actually rather good that
Right.
that the
I,
government responded in the way that it did.
is it fair to say that the Bank of England was effectively just monetizing the government debt at that time to cover the COVID-19 programs? And isn't that inflationary? I mean, it's
Well, okay. Um, Technically, yes, it was. There was quite a lot of sort of debate at the time about whether the government in 2020 about whether the Bank of England was going to explicitly finance the government using the Ways and Means overdraft. You may recall there was a report on Sky.
I know it, yes.
Yeah, you remember the one I mean, which interpreted Andrew Bailey's comments about uncapping the Ways and Means overdraft because it was possible that the government might not be able to fund itself. Now, and that was taken by people, particularly from the MMT school, as indicating that the Bank of England was going to explicitly monetize the government's deficit. I didn't take it that way. What it
Right.
meant to me was that the government, that you must remember that bond markets were very, very disrupted at the time, really disrupted. Yeah, the Bank
And
of yeah,
and their job is to provide market liquidity and stability to the markets. So,
exactly. So the Bank of England was providing massive liquidity to a very, very disrupted bond markets at the time. Gilt markets were all over the place. At the same time as the government was planning a vast increase in spending, which would, of course, be funded by more gilts issuance. And the Bank of England was very worried about having a sudden influx, very large influx of gilts into an already disrupted market.
right.
Right, and so it was considering using the Ways and Means overdraft, in other words, doing monetary financing of the deficit temporarily in order to allow the government to smooth out the issuance of gilts so as not to disrupt the market anymore. That's
Hmm.
what they were doing. Does that make
Right.
sense?
No, it does, yes.
And actually looking at that with hindsight, in the light of what happened in September 2022 with the long dated gilts market, when exactly that happened, we got a sudden influx of long dated gilts onto an already disrupted market, and the whole thing froze. Right? The Bank of
Y-
England was right to be worried.
And they stepped in, exactly. Yeah.
Exactly. Yeah.
Yeah,
As
which is,
absolutely.
which is part of their mandate to do. So,
Absolutely part of
um,
the mandate to do that. Yeah, absolutely. I mean, there may have been in that particular case, there clearly was a failure of regulation, and of course they will need to look at this pocket of hidden leverage that had grown up as a result of very low interest rates for a very long time. It was essentially an unhedged bet on interest rates never rising.
mhm.
Um, which should never have been allowed to happen. But so they have some regulatory issues to look at. But in terms of the market intervention, there, yeah, they intervened to prevent the gilts market freezing. Yeah.
Okay, excellent. Obviously, we seem to be, you mentioned earlier that interest rates, they have been artificially low for a very long period of time. People forget, and some people won't even remember that, you know, kind of a normalization of interest rates is somewhere closer to 4 or 5%, which is, not far off from where we are now. So, I mean, it seems to me that we're never going to go back. I say never, but it's very unlikely that we're going to go back to these kind of emergency rates. And maybe people have to get used to these kind of 3.5, 4% base rates, and effectively mortgage rates of 5%, and that's just how it is going forward.
I am unconvinced. And the reason for that actually is to do with the mortgage market. Because, if I look back to, the kind of where house prices were in the last time we had interest rates at around 5%, the average house price was way lower than it is now.
Yeah.
And wages were also lower, um, obviously. But they have not risen by as much as house prices, nowhere near. And so, in order to buy property now, people have to take on much, much larger amounts of debt. Now, that's affordable if your interest rates are lower. So, for that reason alone, I think that the kind of normalizing interest rates back to like 5% again is not going to happen, simply because actually, for an awful lot of people, it does mean substantial amounts of debt distress, and governments historically, it implies much lower house prices,
So
really.
the interest rate sensitivity of the consumer is much, much higher, and
Absolutely.
therefore this 5% rates, has to
Yeah,
be
absolutely.
reduced.
5% now is a high interest rate, whereas
Right.
20 years ago it was a median interest rate, given where asset prices were then.
And the amount of debt that people now have
The
access
amount
to and have built up.
the amount of debt that people now have to take on in order to buy a property.
Okay. Okay.
And then there's a whole political economy question around this. Now, part of the reason for that in the UK economy is that we don't have enough houses. We know this. We don't build enough houses, but we do have a problem with what we might call NIMBYism, and people who want to prop up their asset prices, who've profited hugely from this vast unearned increase in asset prices from QE, partly caused by QE, and understandably don't want to let that go. Um,
Hmm.
and they vote. And one of the interesting things about the present housing market, as opposed to the mortgage market, is actually how few people have mortgages. Right
I
now,
saw that the other day. It was
ah,
incredible, really.
it's incredible, isn't it, that 70% of the UK's housing market is unmortgaged,
Mortgage free. Yeah.
it's mortgage free. So, we're talking about 30%. When you're talking about so few people really having mortgages relative to the size of the housing market, then
Yes.
clearly the kind of the political imperative is going to be to prop up the housing market, and if that means that fewer people can afford mortgages, well, tough,
Yes.
because they're going to be younger people generally. You've got this huge grey vote that both parties need, and most of them don't have
A
mortgages.
mortgage free.
Yeah,
Yeah. No, absolutely.
I confess I
Absolutely.
am one of them.
Well, I was going to say, I mean, I don't know what's going to happen to the housing market. My personal view is that, as we say, asset prices are going to fall. I mean, I don't think we're going to see a housing crash, but a kind of a slow burn downward
House prices are already falling.
yes, they're
Yeah,
down about 3.5%, 4%
yeah,
annualized, I think.
they
So,
are.
it
I
might
think
get to 10% over a couple of years.
yes, I think, and there is an argument for saying it does need to fall. We could help that by building more houses, but your problem with that is that you can't really rely on the private sector. The reason for that is that no builder will build into a falling market.
No,
What they will
absolutely.
do is hang on to the land, and wait for prices to go back up.
Well, I think this is the argument. I was having a conversation with somebody the other day about this, and who knows the developers very well in London, and they were saying, well, they're just going to mothball them. They'll
Yeah,
just sit on it because they're all expecting the Bank of England to cut rates aggressively at the start of next year.
yeah.
So they're just going to wait it out.
Exactly. And also you will find that people looking to sell their house might also sit tight too. So
Mm,
you see a fall in the supply of houses from that direction as well. That's fairly normal actually when house prices start to fall, is that people who were planning to sell
hmm.
shelve it.
Right.
And in a way that's part of the natural mechanism of a market, that when prices start to fall, suppliers stop supplying.
Yes. And
It's a perfectly normal mechanism, but it does mean that if you actually want your supply to increase because you haven't got enough houses, and you want your house prices to fall because they're too expensive for younger people, then you're in the realms of public policy, not the normal operation of a market, and you need government intervention. So the only people who are going to build into a falling market, frankly, are the government.
the government. No, absolutely. And say the important point there is in a falling market, and that trend is definitely downwards. where's the incentive for the developer? There isn't any.
Absolutely, there isn't one, and there isn't
And
an incentive for the banks either. And that's another part of this. Although we're saying that only 30% of people of properties are mortgaged, nonetheless, that's still a lot of properties.
and it's a high value as well.
It
So
is. And so, from the bank's point of view, they don't want house prices to fall because the houses are the collateral
hmm
on their borrowing, on their lending. Now, admittedly, they are stress tests and firewalled, and they're meant to have enough capital to, and they're not meant to be lending such high LTVs that they could be wiped out by a their collateral could be wiped out by a 10% fall in house value. But at the same time, they have been under pressure to give higher loan to value mortgages. We know that
sure,
95% and 100% mortgages are back.
that's true.
Um,
I've seen that. I mean, it's crazy, really.
it,
But
it, and the collateral will be and that means the collateral will be wiped out in a housing in a house
yeah,
in a falling housing market now, which is very bad news for the banks. So what the banks will do inevitably is cut lending, bound to.
exactly. And of course, it's going to affect those who are recent purchasers of property, who generally will be, the less well off, shall I say, because they're highly leveraged and they have very low deposits, etc., etc. So that
Younger,
sector of the market is going to suffer the most.
yes, absolutely. Younger and poorer people are going to suffer.
Yeah, I
So
do wonder though. I mean, with 5-year gilt yields at what 4.75%, government backed. Why would you go and buy a new build property or something like that at 4% yield in a falling market?
well,
Which
yeah,
kind of just
that's your buy-to-let market, isn't it?
yeah.
Which must surely be completely in the doldrums because, as you say, why would you do that when gilt yields are where they are? No, when gilts are a realistic alternative to property, then you are going to get out of property into
and
gilts.
and for the first time in a decade, they are now. I would argue.
So again, that's going to constrain supply in your rental market, and that's going to mean higher rents.
Well, I think we should end it there. Please sign up for Francis Coppola's Coppola comment on Substack. Thanks a lot. I'll speak to you soon.
Yeah, take care then.